for, and seeing a little decrease in sterling dollar there. Your sterling up slightly as well. Now, joining us now is Jim Rickards, Senior Managing Director at Tangent Capital Partners and the author of Currency Wars, The Making of the Next Global Crisis. Jim, let's start with you and talk about that connection between cross rates and QE3. Explain to me why we need to understand that.
Jackie, when you have a complex situation, which we do, it helps to get one thing right, because if you get one big thing right, then everything else is a little bit easier. The big thing that investors need to understand is the policy of the Fed, the Treasury, and the White House to cheapen the dollar. We want a weak dollar to promote exports. So starting there, you can kind of look around the world and make inferences from that. So how's it going? So far in 2011, it was going pretty well. The yuan appreciated a little bit. The euro was stronger than people expected. Same thing in South Korea. The one exception was Japan. Japan got a pass from the G7 because of the tsunami and the earthquake. But now that's reversed a little bit recently. We see growth, inflation, and net exports from China came in lower than expected. So it looks like China's going to return to a peg, kind of a soft peg. The euro's come down a little bit. I expect it'll get stronger, but it has come down. And now in Korea today, we see the won is going down very sharply on the news. So the dollar is actually getting stronger against the wishes of the Fed. So QE3 is the solution. QE3 is how they will cheapen the dollar. So if you see the dollar continuing to get stronger, look for QE3.
Okay, and I think a lot of investors are expecting to see that dollar get stronger, and we were expecting QE3. Then why, when the Fed met and they didn't really talk about it, the markets didn't take that as a positive sign, if everybody is assuming that it's baked in?
Well, because these developments are fairly recent. The Fed's going to signal us before they do it. There was not a lot of signaling ahead of the December meeting, but now they've got a January meeting. I think you'll start to hear, whether it's January or March, you'll start to hear leaks, so you'll start to see this coming. But the thing is, watch the race. The euro may get stronger on its own if markets get more confidence in this plan, and so that may be a reason to defer it a little bit. So my advice to investors is watch the euro-dollar cross rate and the yuan-dollar cross rate. And if you see the dollar getting stronger, look for QE3. If you see the dollar getting weaker, those currencies getting stronger on their own, it may be deferred.
Okay. Jim, what do you think is the outlook for the euro? You mentioned the possibility, at least, of the euro getting stronger. A guest we had on earlier on the show said actually he does think the euro is going to get stronger, and by this time next year we could be at 135, 136 for the euro as this kind of process goes along. What are your thoughts?
Yeah, I agree with that. I've been saying since last summer that the euro is strong and getting stronger. And the reason for it, despite all the turmoil in Europe, and we're obviously well aware of that, the fact is both China and the United States need a strong euro to promote their exports so the Europeans can afford to buy our goods and services. And the Germans are okay with it. So for all those reasons, I do expect to see the euro get stronger. Now, there are two paths. One is it may get stronger on its own based on confidence in the plan. If it gets weaker because of fear of the plan, then you'll see QE3, and then the euro will rally on QE3. So it could go down before it goes up, but I would expect by this time next year it will be stronger. I think that's right. And
let me just ask you this. A lot of net shorts in the euro right now, actually at an all-time record high. So how long do we go lower before we start to see that bounce?
Not much more, because to me 130 was always the signal, with kind of 130 or below, 129 and so forth. Hedge funds have lost a ton of money since August going short the euro, and that's a huge mistake. I mean, the euro is not going to fall apart. No members are going to leave. They're going to do what they can. It's not an economic issue. It's a political issue, and that's what a lot of investors miss.
All right, let's put a pin in it for now. Of course, both of our guests are going to stay with us. Jim Rickards, Senior Managing Director at Tangent Capital Partners and author of Currency Wars. And we've got James Altucher. A lot still coming up on the show. Is Santa Claus going to deliver on his year-end rally, or is Europe going to continue to hover like a dark cloud over the markets? We're going to get some insight from the bond pits in Chicago right after this break.
Amazing stories. Invest in the night. CNBC.
Some people say travel isn't what it used to be. Well, I think travel is what you make it. So I made it better.
The Gold Delta Sky Miles credit card from American Express? Sure, it earns you miles. But what you'll really appreciate is everything it does to make traveling on Delta a little bit easier. Like when you get to the airport, you get a free checked bag on any Delta flight every time you fly. And now when you're at the gate, you get on board sooner with new priority boarding. So you can get to your seat, settle in, and do, well, whatever you want. And once you're on your way, you'll even save on drinks, movies, games. The little things to make your flight more relaxing. Call 1-800-SKY-MILES to apply now. You can earn 30,000 bonus miles. With a $0 introductory annual fee for the first year, then it's $95.
Can your card make getting there a little bit easier? My card can.
Business intelligence.
Squawk Box. We're going to kick off Squawk Masters Week. BlackRock's Bob Dahl will give us his outlook for 2012, and we have some new masters making their debut. You guys have any guesses about who they might be?
Do we actually tell them?
Here's an important message for anyone who has term life insurance or is thinking about getting one. According to the Penn State University study, only 1 out of 4 term life insurance policies are enforced for the 3rd year. Ultimately, 99% of term policyholders don't collect any money on their life insurance. Would you ever consider throwing your money away in a slot machine for 20 or 30 years if the odds of winning are less than 1%? So why throw your money away on term life insurance? Introducing term life insurance with a money-back guarantee. Term life insurance is a good idea, but if the odds of collecting on a death benefit are less than 1%, then why not get your entire premium back if you don't die? Call BMO Life now for money-back term life insurance and get your entire premium back tax-free if you don't die. We'll show you how to get a check for $20,000, $30,000, or even $50,000 at the end of your term if you don't die. Go ahead, take the first step. Call BMO Life now and join the millions of Americans taking advantage of this new money-back term life insurance program.
Welcome to the show. The headlines today. North Korea's great leader, Kim Jong-il, dies at the age of 69. Regional equities drop with South Korean markets and the won plunging to multi-week lows.
And here in the U.S., Congress is at odds again as House Republicans say they oppose a Senate-passed plan to extend the payroll tax cut by 2 months.
In Europe, a pre-holiday push. Finance ministers today battle to thrash out details of the crisis plan announced by EU leaders earlier this month. So Asian markets have been reacting rather negatively to the news of the death of the North Korean leader. The Nikkei took more of a dive during the trading day, pulling back a little bit, but down by nearly 1.3%. The Hang Seng down by 1.2%. The Shanghai Composite losing 0.3%. Red arrows right across the Asian markets. That's certainly the case if you look at the Kospi, which you may expect would move by the most, being the major South Korean index and having the most impact from any uncertainties, political and otherwise, in the region. 3.4% lower there, 2.4% lower for the Australian markets. The Bombay Sensex just dipping by 0.7%. Onto the European markets, and when we first opened up this morning, we did see a negative trade across the region. That has since turned around, and even since we've been on air here on Worldwide Exchange, we've seen markets gathering a bit of strength. The FTSE has been a laggard, but up by nearly 0.4%, nearly 0.9% higher for the DAX across in Germany. In France, the markets are higher by just about 0.6%. In Italy, 1.2%, nearly 1.3% higher for the FTSE MIB. In Spain, markets up by over 1% as well. So, Jackie, after an inauspicious start, it looks like the markets are moving a little bit higher now, certainly the equity markets at least.
Yeah, and that seems to be the cue, of course, that's pushing our futures higher as well. Right now, if you look at the snapshot, we would open higher at this point. We would see the Dow Jones higher by 40, the Nasdaq slightly lower by 2, and the S&P 500 higher by nearly 5 points. Of course, this was after a down week for the 3 indices last week. Now, with 2 weeks left in the year, the S&P needs to rally about 3%, climbing above 1257 in order to end the year higher. But uncertainty in Europe could remain an impediment, so we're going to need to watch that closely. Joining us now is Michael Gurka. He's a managing director at Chicago-based Spectrum Asset Management. And still with us, our guest host, James Altucher, managing director at Formula Capital. His latest book is called I Was Blind, But Now I See. Michael, I want to start with you and talk about the S&P 500. Of course, this weekend in Barron's saying that we could see a 1360 by the end of 2012. Is that something that you think is realistic?
Absolutely, but not my subscription by any measure. No, I mean, there's no question that we could see those upside bands being tested only because the globe seems to be a little bit more sorted out and a little less complex. But again, you know, just keeping an eye on where we're at today, this 1228 level above happens to be the 50-day moving average. I'm more inclined to see us near 1175. To end the year on an up note, we would need to see that multi-percentage increase here before they close the books. But right now, at least this last week before we get non-holiday trading is going to be really important. So if we could get a little pop today, maybe that's some momentum. But I actually think today is going to be the beginning of volatility on a daily basis that'll take us up and around the market's opening level levels probably through the balance of the day right now, because you know what, I will agree with those upside targets because we do have pristine balance sheets. But again, with what happens in Europe and especially in fixed income markets where levels are these days, I'm more inclined to watch the market be a trader's market more than an investor's market for the next 2 to 3 weeks.
All right, and some analysts that I'm speaking to saying, you know, they're going to write sort of the next 2 weeks off altogether. But here in the States, a lot of issues to consider as well. The situation with Congress right now in Washington. Where do we go from here? How's that going to impact volatility?
Well, it's really actually important to know that it's really good to see the market trading off fundamental events and headline than technical, for the reasons being that we've been addressing these scenarios for the last 13 to 14 months about what's happening in Europe, Greece in particular, of course, our own problems with ratings in the U.S. But right now, at least, I think one of the headlines, as you had just seen with your last segment, is the dollar. And right here against the one-year lows at 128.74 would probably be a downside barometer for support in that contract. I'd be more inclined to see us trade the range. You know, right now, at least, I think globally, a lot of people would like to see the dollar firm up here because there's so many weakening trades in the euro. But the problem is that right now, as most central banks would agree, a weaker dollar is going to be good for everyone. And, you know, you'll get a lot of jawboning on the other side of the pond thinking that that's wrong. But right now, at least, I think there's a good cue there for the euro to keep an eye on this 128.74 level or a breach of 130. If that leads to erroneous moves lower, I think actually you'll start seeing support in the market here. And for the basis of 2012, you'll start seeing some longer positions come into the euro if we break into this 130 era. I actually think you're going to start seeing value down there.
We've got a question coming through on Twitter. Why don't you head along to Twitter, follow me at Becky Me, and get involved in the show. Peter has written in with a question for Jim on Twitter. Jim, with anemic growth forecasts in all major currency countries, who will edge ahead in the currency war, and how?
Well, the dollar will win the currency wars mainly because. Oh, sorry, was that for?
No.
Yeah, it'll win the currency wars because we have the biggest printing press for the time being, until the IMF fires up the SDR printing press. So, in other words, if Europe prints, the U.S. can print more, you know, et cetera. So it'll continue that way. But I'm a little disappointed at the superficiality of a lot of the analysis of the new Euro treaty. You see really smart people like Kyle Bass on CNBC last week saying it's a blank sheet of paper. Well, it's not a blank sheet of paper. It has quite specific targets: 3% deficit to GDP, 60% debt to GDP, 5% a year progress. It has teeth on the front end, so it's really quite an impressive document. At least Europe has a plan, unlike the U.S.
Jim, don't you think this unlimited lending from the EU to banks at essentially 1% forever, don't you think that amounts to essentially quantitative easing in Europe that will drastically weaken the euro?
It's really a liquidity facility. I don't really see it the same as quantitative easing. Quantitative easing would be when you buy the bonds. The ECB will buy the bonds, but not yet. They need to see deflation because that gives them political cover. Deflation's in their mandate.
Isn't it QE in the sense that they're pushing the banks? They're basically lending the banks to buy country bonds. So in a sense, it's like a sort of backdoor QE because they're not by treaty allowed to do specific QE.
Yeah, if they take the bonds back as collateral, then yes, it is an indirect.
And they are agreeing to take the bonds back as collateral.
To the extent,
so Italy bonds, for instance, they're taking back as collateral.
Sure. I mean, there's a reason this hasn't all imploded, and they're between the new IMF facility, what the ECB is doing, what the Fed's prepared to do. You know, so the euro is going to hang together and actually get stronger.
All right, let's put a pin in it for now. We're going to have much more from James Altucher, our guest host, and Michael Gurka as well. Thank you so much, Jim Rickards, Senior Managing Director at Tangent Capital Partners. And coming up on the show, of course, viewers have been writing in, some taking issue with the bullish sentiment of today's guest host. Find out what they have to say along with James's response after the break.